Today, as always, you have Akshay and Deepak with you from Shining Star Funding, and we have John and Deborah with us from Angel Oaks. John and Deborah, I'll just let you guys take it away from here.
Great. Thank you both for giving us an opportunity to be here today. It's always a pleasure. We did this, I think, in person. I don't know, was it a year, maybe it must have been 2 years ago now, Deepak, and it's always a pleasure. We've been doing business together for a very long time, and Deborah and I both appreciate the opportunity to be in front of your clients today and give them a little bit of an update on what's happening on the non-QM market. And for those of you who aren't aware, non-QM is basically a non-qualified mortgage. A qualified mortgage is one that meets agency guidelines, and non-qualified mortgages are mortgages that just fall outside of those guidelines. So we use some unique income calculations, some alternative documentation types. We look at the loans just a little bit differently than the agencies do, and we think we provide opportunities for people that couldn't get loans otherwise. And so anyway, it's a great opportunity to be with you today. Deborah's going to go through some of our products in detail. I'll give you a brief overview on Angel Oak. We've been a partner with Deepak for a long time. Helped him close a lot of loans. He's an expert in this area. He could probably give this presentation rather than me and or Deborah, but we appreciate him having us on. So Angel Oak Mortgage Solutions is one of the largest non-QM lenders in the country. We do all of our business on a wholesale and correspondent basis, so all the business that we do comes from people like Deepak, great partners of ours across the United States. And Angel Oak has been in business since 2013, and we have closed, I think we've helped 11,000 loan officers close a non-QM loan over the last 6 or 7 years. It's just an incredible number. We're thrilled about it, and mainly we're serving a segment of the community that are really good borrowers that just can't get regular financing. And these are good loans for really good people. I think most people are surprised when I tell them that the non-QM market, our average credit score is in the mid 700s. Average loan to value is somewhere between 70 and 75%, and again, loans that are paying. So one of the things that's been really a strong segment of, or kind of, I don't know exactly how to put it, but we've been through a really quite a test during COVID. There were a lot of questions because most of the business that we do is for self-employed borrowers. And there was a lot of big questions that came up in the middle of COVID, whether or not people were going to keep their jobs, or whether or not they were going to be able to survive the pandemic or the shutdowns, so there were a lot of big questions, and we feel like as an industry, the non-QM space has come through the other side in a very, very positive way, mainly because of the things I just talked about. We have really good borrowers who are paying their mortgages. We have good equity in the properties. We just really believe that self-employed borrower and or the investor, we're doing a lot of investor loans these days, and both of these people are groups that pay their mortgages on time. So that gives you just a little bit of a background. I'm happy to answer any questions anybody has, but I think the kind of the next step, unless there's questions, is Deborah's going to go into some of the products in more detail.
Well, thank you very much. It was great, John. So what I'm going to do is I'm just going to go over a lot of the highlights of the program, but I'm also going to point out a lot of the benefits that you can have and take to your buyers and borrowers, and such as the screen that's up right now, the bank statement program. This is going to give your self-employed borrower more buying power. And what I mean by that is when you have a borrower who is self-employed, because that's what this program is specifically for, your self-employed borrower is going to have obviously tax returns, and that accountant is going to have their tax code, which is made up of thousands and thousands of pages, and they're going to take that, apply it to the tax returns. That's going to end up reducing their overall net income. Well, when you have a bank statement program for your self-employed borrower, they're obviously going to be depositing their income into their bank account, and then we're going to take those deposits from their bank account and use that as income. So giving them more buying power from going from tax returns, maybe qualifying at $1 million purchase price. You can take a bank statement loan and look at their deposits on average and maybe give them $1.5 million buying power. So this is a really good tool for you to talk with your buyers when they're self-employed. Don't think because if they have tax returns only that they don't have a way to buy more of a purchase. So I'm just going to go over the bullet points here, and you can see it goes up to 90. I don't know if you've been looking at this while we've been on the call, but you can see it goes up to 90% LTV. There's no mortgage insurance on any of our programs, which is a nice benefit. The program does go down to 640 FICO, and the loan amount max is $3 million, and that will actually go up to 80% LTV. And then our bank statement program for the self-employed borrower is 12 or 24 months. It can be either or. You'd be using a 12-month bank statement program, maybe because you get more income out of that, out of the 12 months. You do need 2-year seasoning for the foreclosure and the short sales and the bankruptcies. And all of our rates are 30-year fixed rates. And the borrower does have to have a business for 2 years. So keep that in mind. Now, when you have a self-employed borrower and they're using a business bank account, they do have to have 50% ownership in that business. They can use a personal bank account, and you would just need to have 25% ownership in that business. And then obviously it applies to purchases, cash out, or rate and term, but you'll be using this mostly probably for purchases. And there is a 1099 option available. We can go into that more later if you like. There's also an interest-only option available, which will help your borrower obviously get their payment down. And I have to look over here. There is an expense ratio applied to all of these programs, and that expense ratio can definitely vary. We can go down to a 15% expense ratio all the way up to a 70% expense ratio. So when you're talking with a buyer about their business, make sure you're asking them what kind of business they have, if they work from home, if they have any employees, if they have a brick and mortar, because that's going to basically tell us what kind of expense ratio we're going to apply to the borrower. Did I leave anything out, John?
No, I think the only thing that I would add, one of the things, I know we've got some realtors on the line here, and we're actually doing a lot of loans for realtors. They're taking advantage of our 1099 portion of this bank statement product, and or bank statements. We do loans for a lot of realtors that are buying either bigger primaries or investment property.
Yeah, and just to kind of go over the 1099 program, how it works is, such as yourself as a realtor, you would take your either the last year or the last 2 years 1099 plus your year-to-date commission printout, and that's all that we would use for income. We don't need tax returns. We don't do 4506T. And then you take that and you would apply also your expense ratio. And as a realtor, you would have probably a very low expense ratio. You may have your desk fee that you pay, but you would have a low expense ratio, and we would go back and get a CPA letter to support what your expense ratio is, apply that to the 1099 and the year-to-date average, and there you go. That's how we would qualify you.
Hey, Deborah, do we have a grade or something available for the expense ratio, or something that can tell us upfront what the expense ratio will be used by the underwriter?
I don't have a grid. John, do you have one like handy?
No, but here I'll kind of take you through it. So our standard expense factor is 50%. We start there. There are some businesses that are kind of have a known higher expense ratio. Retail, medical offices, heavy industrial. Anytime you have either retail space, lots of employees, or heavy inventory, we're going to apply a 70% expense factor. So it gets kind of rich because that's our known industries. And then on the other end of the spectrum, we if you're not one of those industries, then we will apply a lower expense factor based on that particular business. So if you have somebody that works from home, that has no overhead, no inventory, is a service-based business, we will go down as low as a 15% expense factor. And the only thing that you need to provide is a third-party CPA letter confirming that expense factor is what it is, and that's what we're going to use.
Mm-hmm. But how does a CPA provide that kind of a letter? Because the CPA has been seeing the accounts for the last 2 years, and the self-employed person is leaving no profit at all on those accounts that they've been submitting to the IRS.
Yeah, Yeah, it's a good question. We don't really know, but I think what happens is the CPA goes through and backs out all of the paper losses out of the tax returns and comes up with an actual expense factor. That's generally what we see.
Okay.
Any other questions?
No, thanks.
Okay. Then I'm going to move on to our investor cash flow. So that's going to be your one rental program that Deepak was talking about. And this program is amazing. So for realtors out there, if you have an investor group, if you have buyers that just go up and they buy investment properties, this program is great for them because there's no income and there's no employment and there's no max to the number of properties they can own. So that's a really good tool for you to sell to your investors. And what's awesome, I'm sorry, I lose my notes. And also with this program, you can actually, they can put down 20%. So you can actually do 80% LTV. And this product actually goes down to a 640 FICO score. So it's pretty broad with qualifying. And this product is based off the rents that are on the property. So we cash flow the property based off the appraisals 1007. So if the property cash flows, meaning if it's 1-to-1, if the rents cover the mortgage payment, the PITI, then your property cash flows and you're good to go. But say that the property doesn't cash flow, we actually then only require 15% down and you have to have a 700 FICO score. So there's a lot of opportunity in this product for a borrower to qualify. A lot of properties are cash flowing out there right now that I'm seeing because rents are so high. So I don't really run into too much of the non-qualifying part of this program, but it is an option. Another good thing on this program is we do allow the property to take title in an LLC. What's great about that is the LLC doesn't have to be seasoned. So the borrower can actually go out and create an LLC today or tomorrow and then do a loan down the road, like a week down the road. So it's nice that you can just set that up. It would be an LLC specific for the real estate, and then there can be 1 to 2 owners in that LLC.
And the no DSCR with the 700 FICO is 15% down or 25% down?
So if the property doesn't cash flow, you need a 700 FICO score for the 15% down.
25.
25% down. Yeah. So sorry, yes, that's 25% down. I was going the opposite direction.
Right.
Yeah.
Yeah.
That's a great thing.
This is a great loan.
Last loan I was doing, it really doesn't matter what the appraiser comes back with, as long as the 25% down is there and the FICO is good.
Yep.
Exactly.
And what's also a great feature on this program is if the borrower does want to have more cash flow on the property, they can actually do a 40-year interest only. So that is an option on this program. It's one of our only programs that we offer on investment property is the 40-year interest only on this DSCR program. And
then you'll go with the interest only payment only?
I'm sorry?
For DSCR purposes, you'll go with the interest only payment?
That's correct. No, for DSCR, so to qualify, we do qualify the borrower on a 30-year PITI payment, so 30-year amortization on PITI, but the 40-year interest only is going to give you 10 years interest only the first 10 years, and then it's going to recast into a 30-year fix at that rate that it was locked in at.
Mm-hmm. And the DSCR test will be on the 30-year payment?
That's correct. Correct.
Yeah. This is just an incredible loan. If you know anybody that's looking to buy investment property with experience, no experience, we don't care. It can be their first investment property. It can't be their first property because they have to own a primary. But it can be their first investment property. It can be their 20th investment property. No limit on the number of properties owned. This is just a really, really good loan. It's a good loan for people that want to buy an investment property. It's a good loan for people that don't have good current income. So, we're not looking at employment here. We're income. We're not calculating a debt to income ratio. This is just looking at the property itself and the credit score, and that's it.
One quick question: is the loan also in the name of the LLC, or is the loan in the name of the individual?
The loan is in the name of the individual, but title will be in the LLC.
Correct.
Yeah. And this product actually does go all the way up to $1.5 million on the loan amount too. So if you have that also does 4 units. So again, it's a great tool for, especially for investors looking to build their portfolio.
Mhm.
Yeah. And one of the nice things about working with us, and we've done, I'm sure, multiple times with Deepak, is we make exceptions all the time. So if you have somebody that's got a little bit higher loan amount than what we've stated here, we're happy to look at that.
Mhm.
Absolutely. And I'm going to piggyback off that. We actually do make exceptions on all of our programs. Just all depends on what it is. So if something doesn't fit the box, please ask.
That's right.
Sure. Yep. Okay. Then I'm going to move on to the 95%. That's going to be one loan with 5% down. So this is our full doc platinum jumbo program. And again, 5% down, no mortgage insurance. You do have to have, I think it's a 720.
720. Yep.
720 FICO for the 5% down. And this goes up. So if you have a 5% down, your max loan amount is going to be $2 million. If you do have a 10% down, your max loan amount can go up to $3 million. There is always wiggle room in that too. So again, just please keep that in mind. Again, this is a full doc program, and we can do purchase, cash out, or rate and term on all of our programs actually. And all of our programs actually offer the owner-occupied second homes and investment property except the DSCR. This program does require 4 years seasoning for the foreclosure, short sale, or deed in lieu. And it also does offer the interest only on primary properties and second homes, the 1-year tax return program. So it does offer the 1-year tax return program. I think that's kind of self-explanatory.
Yeah.
Right?
Mhm.
Yep. Yep. Just to kind of cover our non-mortgageable condos. So non-mortgageable condos for us is going to be like, say that the condos has 100% investor concentration. So you won't normally see 100%, but that's how we sell it. It's like they have 100% investor concentration. That's okay. We're also a little bit more lenient on the reserves that the condo project may have. And also some litigations, as long as litigation isn't going to be tied to the builder or any kind of maintenance on the property defects, then we're a little bit more open to that too.
A single entity owning a certain percentage over the Fannie Freddie percentage.
I didn't hear you. I'm sorry.
A single entity. I think it's
owning
20%.
20%.
Yeah.
Yeah.
So if a single entity is owning more, which makes it non-warrantable, will you
Yep.
entertain it?
Yeah, so our max is 20% for one single entity to own. As long as it's 10 units or more, only one entity can own up to 20% of the units. And unfortunately, that is a hard stop. I do know that.
Yeah.
Yeah. And say that the units are 10 units or less, then only one person can own one of the units. Yep.
Fannie, yesterday I was looking at a scenario. Fannie had 20% with 21 units and more, and Freddie had 25%. So Fannie and Freddie were different to the extent of 20 and 25%. And when the units are less than 20, it was 2 units. Like you said, the 10%.
Okay. Well,
Maybe
we'll look into that.
maybe it's the same with you also then.
I'm
Yeah,
taking
well,
notes. I'm taking notes, Deepak.
I
Yeah.
think you're following the Fannie Freddie guideline. I think that's what you're doing, right?
Okay.
Mhm.
And can I just leave you with one last thing? Because I know we're kind of rounding up on the 30-minute mark. It'll come here quick. I just want to leave you with the delayed financing. So on delayed financing, we do offer that on all of our programs. I know you have it too, Deepak, but I wanted to kind of make it a little bit more broad because on delayed financing on the agency loans, you can't pay off a private mortgage lender. So we just expanded our guidelines to where you can now pay off a private money lender. So if you have a buyer out there that is competing for the property, because you know how fast inventory is going and they're going $100,000 to $200,000 over asking, you know, they can go and if they have the cash, have them pay the cash for it. Come back to Deepak and do a delayed financing program. And if they do private money, we actually will allow that private money loan to be paid off and they can recoup some of their costs up to 90% LTV.
Mm-hmm. Great. Yeah,
Within 90, and the big difference is within 90 days. So if they use cash, you can do it up to 6 months after the purchase. If you use hard money deal to close, it's up to 90 days.
I see.
Correct. Yep.
Good one. We're seeing a lot of that too.
I'm getting a lot of questions on that. Yeah, our biggest programs are going to be the bank statement program and the delayed financing, the DSCR cash flow product.
Excellent. Yeah, there are definitely niches which you're tapping on and which can definitely are bringing business, and we can send that business to you.
Perfect. We're here to help.
Excellent. Any other questions?
Nope.
Any-
All this, Deborah, all this information is available that you have pulled up. It's just available on the website, right?
That's correct. So our website is angeloakms.com. So Angel OAK, there's ms.com. And you would go to the programs and you can go right here and review this. It's all public availability. Absolutely.
Excellent. Akshay, you have any questions?
Nope, not right now. I'm sure we'll get some questions and we'll direct them your guys' way.
Perfect.
Excellent.
All right.
Hopefully my dog barking in the background wasn't too much of a distraction.
Yeah, we could hear Deborah.
Well, thank you for having us. I greatly appreciate it. I always appreciate your time.
Thank you so much. That was quick, concise, and to the point. Appreciate it.
You're very welcome.
Okay. You guys have a
Thanks,
great
guys.
day. All right.
You too.
Take care.
Bye.
Bye.